As we all know, economics is macroeconomics plus microeconomics. In this series, we shall look at national income accounting, growth, inflation, unemployment, income, international linkages, consumption, savings, investment, money demand, credit and central bank, financial markets, asset price, exchange rate regime, macroeconomic policies. First, the concept of short run, long run, and intermediate run in macroeconomics. In the short run, it is seen that prices are sticky and they are not affected by the aggregate supply, as we can see in the diagram. Output is determined by the aggregate demand. In the long run, the prices are flexible and they are determined by both the aggregate demand and the aggregate supply, as we can see in the diagram. However, output is determined by aggregate supply, but changes in the aggregate demand is what results to very high inflation rates. In the intermediate run, the slope of the aggregate supply is positive, unlike in the short run and the long run, and prices and output are determined by an interaction of aggregate supply and aggregate demand. GDP is the market value of all final goods and services produced in a country at a given period of time. We can also see it as the sum of factor payments, of which labor is the major factor of production. It is important to avoid double counting in GDP, so only final goods are measured, for example rice, not paddy. It also measures current production or the value added at each stage of production. The GDP measurement can be approached in two ways. The first is expenditure approach, while the second is the income approach. The difference is in the expenditure approach, we look at money spent in producing the aggregate output, while in the income approach, we look at the total income in the economy, including tax, indirect taxes, depreciation, net foreign factor income. As we know, the net foreign factor income is the gross national product minus the GDP. The abbreviations can be seen in the red, in the box in red. The gross national product is the GDP added the net foreign factor income, while the net domestic product is removing depreciation from the GDP. The national income involves removing indirect taxes from the net domestic product. The problem with GDP measurement is that 1. Off-market goods and services are not accounted for. This can be in form of self-repairs of personal electronics or household pumps. Then output from the vegetable gardens, family vegetable gardens may not be accounted for in GDP, except they are sold in the market. Then crimes and externalities from the use of goods and services are not measured. For example, using a bad tire can result in accidents. Accident is a cost that may not have been may not appear in the GDP. Then improvement in quality are difficult to estimate. For example, how do you estimate a ketchup that is good and that which is very good? Then indirect taxes, I added a short note here. Taxes levied on goods and services instead of rather than on individuals or companies. As we know, direct taxes are paid directly to the government, but in indirect taxes, they are mostly included in prices of goods and services sold by intermediaries, especially like the supermarkets. Examples of indirect taxes include the sales tax, the per unit tax, the value added tax, VAT. In the economy, the income can be used for consumption, investment, or other government spendings. So when we subtract from the aggregate output the consumption and government expenditure, we are left with investment and net exports. The investment and net exports, we can say, equal to the national saving after consumption and government expenditure has been removed. So when we subtract investment from both sides of the equation, we get the savings investment gap, which is normally equal to the net exports. Then it is important for us to note that when the net export is zero, it means that the economy has a balanced trade. Then savings is equal to investment. But there is trade surplus when the export is greater than the import. Then we can say the savings is greater than investment, and the country is able to lend in the international market. But the reverse is the case. If export is less than import, then we can say that savings is less than investment. Then that country is liable to borrow from the international market. Uh, on the budget aspect of it, when the government expenditure is equal to the tax minus the transfer payments, then we have a balanced budget. We can also say that savings is equal to investment. But in the case of budget surplus, government expenditure is less than the tax minus government transfer. Then that economy is able to lend or buy bond from the financial markets because savings is greater than investment. Then the case of budget deficit is a situation where the government expenditure is greater than the tax minus government transfer. So it is observed that savings will be less than investment. So there may be need for the economy to borrow. Uh, this is a bonus. This is a 2014 World Bank report of the top 24 countries by GDP PPP. PPP is the purchasing power parity. The UN often use the PPP as an indicator for human development, called the Human Development Index. Uh, the good thing about GDP in PPP is that it compares the purchasing power of the citizens of one country against those of another country rather than the total size of the national economies. So China is sitting comfortably on the top, number one, followed by the US, India, Japan, Russia, Germany, Brazil, then Indonesia number 8. Nigeria is sitting number 20, just uh, after Nigeria we get Australia, Thailand, Argentina, and Poland. We hope more African countries can join the chat in the next few years. Thank you. In the next sections, we're going to look at inflation and unemployment growth, consumption money, international money, credit central bank, financial markets, exchange rate regime, macroeconomic policies. Thank you. Terima kasih.